Picture this. It is March 2026.
All right.
A sudden geopolitical conflict escalates out of nowhere. And within hours, the Strait of Hormuz is effectively shut down.
Just completely blocked off.
Exactly.
Yeah.
Instantly, 20% of the world's oil and liquefied natural gas is trapped. It just cannot move.
Wow.
And within days, global data centers, automated manufacturing hubs, entire national grids, they realize they simply cannot afford the skyrocketing costs to keep the lights on.
Because the supply shock is just immediate.
Right. The broader market is in absolute panic.
Yeah.
So the question is, what does the smart institutional money do in that exact second?
Well, they definitely don't do what they used to do, I can tell you that.
Yeah.
Yeah, I mean, the old playbook of hiding in cash or retreating to fiat-backed government bonds, it simply does not work when the crisis is a physical shortage of the materials that actually power human civilization.
Which means the traditional compass for a safe haven asset is fundamentally broken.
Completely broken.
Right. And if you are listening to this right now, whether you're an institutional fixed income investor, maybe a sovereign allocator, a treasury manager, or you're running a private wealth platform, you already know the ground is shifting.
Yeah, they feel it.
Global capital markets are entering a completely new era of defensive allocation. I mean, conventional money markets and traditional property REITs are facing just relentless pressure from inflation, currency uncertainty, and deeply compressed real returns.
Right, because the definition of safety, it's no longer just about preserving capital on a spreadsheet.
No.
It is about tying your capital to real asset-backed yield preservation. You need physical reality.
And that brings us to the two really vital intelligence briefings driving today's deep dive.
Yeah, these are fascinating.
First, we have a highly detailed geopolitical and investment memo from NECSA Capital Partners. And that's the one that outlines that very specific hypothetical March 2026 supply shock.
Right, the Hormuz scenario.
Exactly. And second, we are pulling from a massive country-by-country breakdown of Asia's energy transition, which is sourced from Energy Tracker Asia.
So we basically have two totally different lenses here.
Yeah.
One is this macroeconomic geopolitical risk lens, and the other is a highly specific regional data set. But, they both point to the exact same structural shift.
Which is wild.
Okay.
So our mission today is to explore how this geopolitical fragility, paired with just an almost incomprehensible level of structural demand, is driving a historic capital rotation.
Trillions of dollars.
Literally trillions moving away from traditional paper into long-duration energy infrastructure. And we're also going to examine why early entry opportunities, specifically structures like the NECSA program, are emerging as critical vehicles for institutional wealth preservation.
It's a huge shift.
Okay, let's unpack this. We really have to start with the catalyst itself.
Right. So the NECSA Capital memo opens with that stark scenario you mentioned, a severe physical disruption at the Strait of Hormuz. And I think we have to pause and look at the sheer logistics of that waterway to understand the vulnerability.
It's a tiny bottleneck, right?
It is. A full fifth of the world's oil and LNG squeezes through a channel you can practically see across.
So paint the picture for us. The strait closes. Walk me through the domino effect mechanically.
Okay, so step one is immediate price elasticity just snapping. Oil prices shoot vertically.
Makes sense.
Step two, LNG, and more importantly, the highly specialized scarce ships required to transport it, they become exponentially more expensive overnight.
Right.
So buyers who relied on gas suddenly find themselves priced out, or they simply are unable to secure delivery.
Which forces them to scramble for a fallback.
Exactly.
And that fallback, ironically, is coal.
Yeah, the desperate bid for coal spikes its price globally. But that leads to the ultimate bottleneck, the final step in the cascade. Everyone who relies on electricity, which is basically every single critical industry on Earth, starts panicking over cost certainty.
I always think of this like a bank run.
Oh, that's a good way to look at it.
But instead of a mob of people rushing to a teller window to pull out their physical cash before the vault is empty, you have global industries and sovereign nations rushing the grid.
Yes.
They are desperately trying to secure stable, predictable power. I mean, they're looking for yield in that moment. They're looking for operational survival. They want electrons.
What's fascinating here is how institutional capital reacts to that exact bank run.
How so?
During a shock of this magnitude, capital actively pivots away from assets driven by market sentiment or, algorithmic trading or consumer feeling.
Wait, hold on. I want to push back on this a bit.
Sure.
If traditional bonds are failing to offer yield and inflation is running hot, why doesn't that smart money just pivot directly into commodities? Like, why not just buy oil futures or gold and ride out the storm?
Because a gold bar or a futures contract doesn't power a data center.
Ah,
Right.
yeah.
An oil future doesn't keep a semiconductor plant from shutting down mid-run. Institutional capital is realizing that the ultimate flight to quality is moving toward essential physical demand.
You actually need the infrastructure itself.
Exactly. You need to own the assets that economies absolutely must have to function on a daily basis, regardless of stock market volatility.
That makes a lot of sense. It's funny, to think that the incredibly advanced multi-billion-dollar AI that's writing our code and optimizing our supply chains is ultimately just a very thirsty customer begging for a lump of coal to keep its servers from melting down.
That's the perfect way to frame it. And the Nuku memo actually breaks this new reality down into 3 organic shifts or pillars that are completely redefining infrastructure investment.
Okay, let's hear them.
So the first pillar is that electricity is functionally replacing oil as the ultimate strategic commodity.
Right, because in the 20th century, oil decided the fate of nations. It moved militaries, it fueled the Industrial Revolution.
But today,
Today, the cutting edge of the global economy, hyperscale AI data centers, mass automation, EV mobility, none of that runs on crude. It requires one single input, which is reliable electricity.
it is the new strategic bottleneck. Now, the second shift is how we handle reserves. We all know the concept of the Strategic Petroleum Reserve, right?
Right, countries pumping millions of barrels of oil into salt caverns to guarantee stability during a crisis.
Exactly. Well, large-scale battery storage is becoming the strategic reserve for the modern grid.
Because it allows you to control time.
Precisely. By storing power when the sun is shining and it's practically free, and then deploying it during a heat wave when grid prices spike, the owners of utility-scale storage gain absolute control over scarcity.
Which is incredibly valuable.
In commodity markets, controlling the timing of delivery is just as valuable as the commodity itself.
And that leads into the third concept, which is where the financial engineering really meets the physical concrete and copper.
Yes, pillar 3.
Energy infrastructure is effectively becoming the new institutional bond market. I mean, for decades, pension funds and sovereign wealth funds relied on government paper for safe, steady, long-term returns.
Right.
But with those bonds struggling to offer real inflation-adjusted yield, they are literally swapping paper for physical infrastructure.
Let's dig into the mechanics of how that actually works, because it's not just about, buying a power plant and hoping for the best.
Oh,
It's about the PPA, the power purchase agreement. When an institution invests in one of these physical infrastructure assets, they are securing long-term contracts, often spanning 15 to 25 years, with massive commercial and industrial customers.
here's where it gets really interesting, and I really want to highlight this for anyone listening who manages allocations.
Yeah, this is key.
This is not about venture capital. This isn't about betting on some volatile tech startup trying to invent a new battery chemistry or trying to pick which solar panel manufacturer will win the market.
Right, that is speculative tech investing.
Exactly.
You are buying the toll road, not the cars.
Yes.
Yeah.
You are buying the underlying infrastructure that every single technology must utilize. When a massive manufacturing facility signs a 20-year locked-in power purchase agreement, they are legally guaranteeing a stream of cash flow in exchange for an essential utility.
Because their downtime costs them millions of dollars an hour.
Exactly. So their demand is incredibly sticky. That contractual guarantee creates a bond-like yield, but it offers superior inflation protection because power prices structurally rise with inflation.
And trillions of dollars in AUM are already recognizing this and beginning the rotation. But having the macro theory is only half the battle.
Right.
To understand where this capital must actually be deployed to capture that yield, we have to look at the battlefield itself.
And according to the Energy Tracker Asia briefing, that battlefield is definitively Southeast Asia.
Without a doubt.
This region is the front line of the global energy transition. It represents a level of structural demand that is frankly hard to comprehend. I mean, Asia is responsible for over half of all global greenhouse gas emissions.
Yeah, if we connect this to the bigger picture, the data reveals a massive struggle. Instead of just listing off countries, look at the overarching themes. And the most glaring one is the coal paradox happening in heavy industry.
The paradox is staggering. Take China and India.
Right.
China currently contributes nearly half of the entire world's solar and wind capacity. They're building renewables at a pace that just breaks historical records.
It's incredible.
But simultaneously, they're operating massive dominant coal fleets, particularly for heavy industry. And India is targeting 90 gigawatts of non-fossil fuel capacity by 2030, heavily prioritizing solar, yet coal still dominates 70% of their power generation.
You see the exact same paradox in Indonesia. They operate Southeast Asia's largest coal fleet, over 45 gigawatts spread across nearly 250 units.
That's massive.
And despite having vast untapped potential for geothermal and solar, they are actually continuing to expand their captive coal power capacity to feed industrial demand.
Okay, let me stop you there, because here's what confuses me.
Sure.
We just spent the first half of this deep dive talking about how electricity is the new oil and how trillions of dollars are rotating into clean infrastructure.
Right.
If that is true, why are places like Indonesia still building dozens of new captive coal plants? If the smart institutional money is in solar and batteries, why is the reality on the ground still burning black rocks?
It is the most important question you could ask, and the answer is grid flexibility.
Grid flexibility.
Yeah. The bottleneck in Southeast Asia is not a lack of demand for clean energy. The demand from commercial and industrial sectors is insatiable. The problem is a critical shortage of deployable infrastructure capacity.
Okay, so it's a delivery problem.
Think about the mechanics of an aluminum smelter or a hyperscale data center.
Right, they need baseload. They need power 247.
Exactly. They cannot tolerate a drop in voltage just because a cloud rolled over a solar farm for 10 minutes. You cannot drop a massive AI data center into a region and expect a legacy grid built in the 1980s to handle that load volatility.
So what does the factory owner do? They build a captive coal plant right next to the facility.
Yep.
They build their own dirty microgrid because they know that when they shovel coal into the furnace, the power turns on. It guarantees their operational survival.
Even if it is less efficient, exposed to volatile fuel costs, and environmentally damaging in the long run. Until there is enough utility-scale battery storage paired with decentralized renewable generation that is actually plugged into a flexible grid, these industries have no choice.
And we see other regions struggling with different variations of this exact grid bottleneck. Look at Vietnam.
Yeah, Vietnam is a great example.
They offered massive incentives, and their non-hydro renewable share surged to 16% in 2023, and it's heading for 19% by 2026.
Which sounds great.
It does.
Yeah.
But they built so much solar so fast that their transmission lines couldn't handle it. They faced massive curtailment, having to literally throw away clean energy because the grid couldn't move it to where it was needed.
And then you have highly developed, dense island nations like Japan and South Korea.
Right.
They are planning massive solar and wind build-outs, but their land constraints and grid reality force them to look at alternative technologies. Japan, for instance, is heavily prioritizing hydrogen and ammonia co-firing, alongside carbon capture and storage, or CCS.
Which is a highly debated topic.
Very debated.
Critics argue that relying on CCS and ammonia simply delays the deployment of proven, cheaper solutions like wind and solar, while proponents argue it's the only way to utilize existing infrastructure in a land-scarce country. We aren't here to judge Japanese energy policy, but the raw data speaks for itself. Coal, oil, and gas still account for roughly 85% of Japan's energy supply today.
And places like the Philippines and Thailand are grappling with fundamental distribution issues. The Philippines gets just 3% of its electricity from solar and wind, well below global averages, primarily because their archipelagic geography requires massive, complex grid upgrades.
Right. Islands make grids very complicated.
I read.
So when we synthesize all of this intelligence, the geopolitical threat of a 2026 supply shock, the institutional capital rotation into infrastructure, and the desperate bottleneck need for deployable grid solutions in Asia, it brings us to a really actionable conclusion.
Yeah.
The market is moving much faster than conventional institutions realize.
Because commercial and industrial or C&I customers cannot wait for a national grid upgrade in 2035. They need long-term energy cost reductions and supply resilience today.
Which is why we are seeing the emergence of highly targeted structures designed to solve this exact bottleneck.
Exactly.
The NECSA program, specifically NECSA 1, is a perfect example of this new asset class. It is essentially a new generation of energy infrastructure fixed income opportunity.
Let's break down how a program like NECSA 1 actually functions under the hood, because it directly addresses that C&I dilemma.
Please do.
It combines the massive energy transition demand with physical solar and battery infrastructure. But the key differentiator is the integration of AI-driven power optimization.
I want to clarify this for the listener because AI-driven power optimization can sound like a jargon salad.
Fair enough.
Let's look at the actual mechanism. Think of the AI in a system like NECSA 1 as an incredibly high-speed air traffic controller for electricity.
That's a great analogy.
It sits at the factory level, looking at the solar panels, the battery storage, and the legacy grid. Millisecond by millisecond, it analyzes the real-time price of power. It decides, okay, grid power is cheap right now, so let's buy from the grid and charge our batteries. Or a heat wave just caused grid prices to spike, so let's disconnect and run the factory entirely off our stored battery power.
And by performing that continuous arbitrage, the system buffers market volatility and drastically optimizes the baseline energy costs for the industrial customer.
That's brilliant.
It provides the exact reliability that previously required a captive coal plant.
But crucially, from the perspective of the institutional investor, it wraps that physical asset and that AI optimization into an infrastructure-style yield framework.
Right.
The C&I customer signs that long-term power purchase agreement we discussed earlier. That creates long-term cash flow visibility. It is the toll road.
So what does this all mean for portfolio strategy? The structural demand is undeniable. AI expansion, data centers, industrial electrification, and basic energy security requirements are creating an unprecedented thirst for stable power infrastructure across Southeast Asia.
So what does this all mean for you, the listener? The urgency here is the most critical takeaway. The challenge ahead for capital allocators is not a lack of demand. The challenge is a severe shortage of deployable infrastructure capacity, a lack of qualified project pipeline, and heavily constrained secured allocation quotas.
Because once the massive tranches of large institutional capital fully wake up and enter this sector, those deployment quotas in premium projects are going to be completely pre-allocated.
They'll be gone.
Access flexibility will narrow significantly.
You are not simply investing into a financial product to hit a quarterly benchmark. You are securing a position within a future energy infrastructure reserve system. If the Nuku memo's timeline is accurate, 2026 may become one of the defining years of the institutional wealth preservation transition.
Yeah, it really could be.
It will mark the moment capital aggressively rotates from passive, conventional instruments into productive energy infrastructure assets that possess true economic necessity.
This raises an important question for anyone managing capital today. How resilient is your current portfolio against a fundamental energy shock?
Seriously.
Early participants in transition opportunities are acquiring defensive yield exposure. They are locking in a strategic fortress against long-term currency devaluation and the erosion of purchasing power.
Because the earlier the positioning, the stronger the ability to secure that future pipeline participation. Yeah. You're tying your capital to the one physical reality the global economy cannot survive without.
We have covered a tremendous amount of mechanical and geopolitical ground today.
We really have. We started by looking at the sheer logistical vulnerability of the global energy supply chain, with 20% of the world's oil and LNG exposed at the Strait of Hormuz, and how a physical disruption there cascades into a desperate global grab for baseload power.
We examine the structural rotation of institutional capital, watching it abandon fiat-backed bonds and speculative tech bets to pour into the new economy's essential pillars.
Right.
Electricity as the primary strategic commodity, battery storage as the new strategic reserve, and physical infrastructure PPAs replacing the bond market.
And then we analyzed the deep contradictions in the Asian theater, the heavy industry paradox of building massive renewable capacity while simultaneously expanding captive coal fleets just to keep microgrids stable.
Yeah, the grid flexibility issue.
Exactly. And finally, we explored how structures like the NECSA program represent a rare early entry window to capitalize on this bottleneck, utilizing AI, arbitrage, and physical storage to provide the exact cost certainty the commercial sector is begging for.
The transition is happening. The physical realities of power generation are reshaping capital flows. The only variable left is whether your capital is positioned to defend itself and capture the value being generated.
Which leaves us with one final thought to mull over, building on the mechanisms we've unpacked today. We started this deep dive talking about the shifting definition of a safe haven. If physical energy infrastructure, the power generation, the battery storage, the contractual PPAs, is truly replacing the traditional government bond as the ultimate safe haven asset for massive institutions.
What happens to the broader global financial system when those traditional bonds lose their perceived safety?
Exactly. When paper backed by fiat currency is forced to compete with physical, essential power.
It's a sobering thought.
Are we looking at a rapidly approaching future where access to physical electrons and the infrastructure that stores them is the only currency that truly holds its value? Because if we are, That compass pointing to safety isn't pointing to a piece of paper anymore. It's pointing to a battery array. Thank you for joining us on this deep dive. Take a hard look at your allocations, understand the structural shifts happening beneath the surface, and position yourselves wisely for the future.